those places.
Can you speak to kind of markets that you're excited about in 2025?
I think we continue to be excited about the Boston MSA. I think some of the Sunbelt markets are going to turn a corner. Yeah. I think Central, South Florida turning a corner. I agree with you on South Florida. The two properties we have down here may have had some negative lease trade out, but it's not rampant. Central Florida pockets seem to be turning a corner. Jacksonville still feels like it has some time. It's going to maybe the back half of the year. Yeah. Austin's going to take some time. Dallas feels like Dallas and Houston feel like they're in better shape than Austin, but I think the back half of the year they'll turn a corner. Yeah. We really like Vegas. So
why?
So I think if you look at Vegas, we've been an investor there for 10 years now. We've done really well there, and I think it was end of 23 unemployment was. Maybe at the beginning of 23, unemployment was 6%. It dropped to 5.1. It's still above the national average, which means there's people who can take jobs. Mm-hmm. I think it's becoming more and more of a grown-up city. Yeah. And then if you look at supply, it's 2% of stock for a couple of years, where Charlotte could be 9% or Raleigh. Right. So there isn't a supply issue as much.
Is that just naturally, or is there policies that?
I think some developers are afraid to build there, so that keeps a lid on it. And then even though you think it's in the middle of the desert, it's sort of landlocked with federal land, so there's only so many places you can build. It's this market we've done well. So that one doesn't have the crazy supply imbalance like some of the other Sunbelt, which is why you saw us buy a couple of deals last year there.
Right. And then as it relates to what you guys are looking for, let's not talk about any markets in specific, but are you more excited about value add deals, core deals? I know your buy box is a little more loose than other folks, but I'm just curious what you're excited about.
I think today is just in general one of the most exciting times to be an apartment investor. Previous cycle, which we'll say ended in early 22, being a good operator mattered, but everyone made money for the most. You had to really make a mistake to not make money. And then I think that attracted a lot of people into the industry, particularly in COVID, that thought it was easy money, and it's turned out not to be. Yeah. I think today a deal could be marketed, and the cap rate, the differential in cap rates for vintage, location, MSA, broker, whatever, is just all over the place. And we're seeing this on the sale and the buy on deals that we're offering everywhere. So you could literally bid on an 80s deal in this city and an 80s deal in that city, and this could be a 5.2 cap and this could be a 6.
Oh, wow.
And then if you look at under the hood operationally, this operator's controllable expenses are 20% higher than they should be, and this one's not. So where can I add value? Right. So I just think it's exciting to be buying in that time. Right. I think when we're looking at opportunities, it's very simple. Can we find just a mispriced deal where it feels cheap? Yeah. That would be great, just a value buy. Then we call the 3 pillars of true America value add. Obviously there's the renovation CapEx perspective, which we have our own in-house CapEx and construction management team, which some people are hesitant on with unit renovations, but can you underwrite the deferred properly on older assets and then do things that are creative without overspending? Yep. I think we're great at doing that. Then can you implement technology? So is there, whether it's revenue management or, we actually use third-party management, but we have every management company on our own technology platform. So I can pull up on my computer and I can see who's taking a long time to close out service requests and who's closing them out quickly. Mm-hmm. And you can quickly see, without looking to arrears months and months, everything in real time, right? Yeah. Your marketing spend, your one chart of accounts across 8 different management companies. Right. So can we implement technology that, are you using AI for better customer service, whether it's the leasing chatbot, things like this. I'm in the weeds on with what we do with our teams. So can we implement some levels of technology that will improve overall operations? Yeah. And then can we implement institutional property management? So we're a top 5 client of most of the big management companies, but then we have this layer of asset managers, investment professionals that really drive the business plan. Yep. So combining those two things plus our scale, can we drive value in that way? So ideally, I buy a deal cheap, and I can do all 3 of those things in a market with tailwinds. Right. That the market research or our 60,000 data points says that there's tailwinds. So for example, when we bought that deal in Boston in 2023, we said originally with our market research project that Boston should perform well based on the third-party research. But then we looked at the data points we had all in Boston, and guess what? We were seeing decent trade out, not negative trade out like other markets. And so that allowed us to kind of lean in on a deal at a time when the 10-year went to 5% and everyone was really scared, right? So we can use the third-party data plus our own data and then our platform to add value. So I'm looking where, not just buy a deal and hope the cap rate goes down or get good rent growth. Yes, I want that to happen, but under-managed, under-operated assets in some form or fashion. It's not, value add was always defined as like renovating.
Right.
And
the
I
carpet,
think,
the kitchen counter.
There's more to value add than that.
And it makes a lot of sense. I actually hadn't thought about that narrative of, because of the easy money, there was a lot of, less professional, less sophisticated people that got into the space. And now they're probably selling assets that have a lot of meat on the bone from an operational perspective that you guys can capitalize on.
Just take expenses. Like everyone got so used to this narrative on inflation that when you look at some of the properties, like the expenses are just out of whack.
Right.
And we'll be in diligence. We'll bid out the contracts.
While you were doing RFPs for pest control nationally. And
so it's funny. Like it's true. Like I literally could point to can we get a better elevator contract at this property that's maybe more full service or less cost? Or can we, we had a property we bought recently. We own a deal 3 miles away. Yeah. It's 8 units smaller than the deal we're buying. And they're
it's 200-300 units, I'm assuming. Okay.
Yep. It's a couple hundred units.
Yeah.
So the property we own is 3 miles away. It's 8 units smaller than the one we just bought. And the trash expense at the property we just bought was double our property. Well, how does 8 units more have double the trash?
Yeah.
So we looked under the hood and we're like, okay, we can get a new trash contract. We do this and this, and we cut the trash expense in half.
Right. And now our 5.5 cap looks like a 5.8 cap.
Well, exactly. So what the market might view that cap rate deal, to your point, might have been, a 5.6, a 5.7, 5.8. To us it was a 6.1.
Right.
So I'm trying to add some value in some way, but I'm going to be very careful. There's what I call abracadabra acquisitions.
Yeah.
Hocus pocus. Yeah. We're just like, oh, we'll just cut the expenses.
Yeah.
Well, no, you're not just cutting the R&M because you're going to wave a magic wand. Yeah. That's where the operating hat comes on, and we try to teach our acquisitions team is prove out the expense savings.
Yeah, like how?
Yes, you have to prove it out. Literally bid everything out and show that you can reduce it. Yeah. And I think we're seeing across our portfolio now, if you're working your vendors properly, we're not getting increases on contracts.
Yeah.
Some are going down.
Right.
So trying to work every angle to squeeze out value.
And you also have an advantage, I'm assuming, on the insurance front because of the size of your portfolio and your company and stuff like that. Because I feel like a lot of my buyers oftentimes struggle with insurance to this day.
So there's two approaches to insurance that you'll see in the market. And this is another thing that I kind of work with Mark Enfield, our CIO. We kind of run our insurance program together. We used to have an MIP. Master insurance policy, not an umbrella. Do you know how many people I talk to like, oh, do you have an umbrella? No, an umbrella is your excess coverage after your GL.
Correct.
And so we had an MIP, 13, 14, 15, 16, 17. And what I noticed as I was trying to buy in Florida is all of a sudden our MIP got very expensive in Florida. And so there's also regional carriers. You can get a regional insurance policy if you just have one property with a regional program. And so we actually pivoted our strategy in 18, 19, where we got off the MIP. The MIPs were more expensive, and we pivoted more of a regional program. And so there's one major carrier that really does coastal markets like in Florida, and they became more competitive. In 2023, they actually got very expensive, and Florida got pretty tough. So we have regional programs, multiple different programs we can put a property on. And then we also have our third-party management relationships. So when we had a very hard insurance market, I could use all of my programs, or I could use a management company's program. So
I remember Graystar was doing this.
Graystar has an MIP, RPM has an MIP. Most of the big management companies have an MIP that if you're a client, if you use them, you could go on.
Yeah.
So
I even saw clients not manage their own deals so they can get into the MIP.
Right, that's how hard the market was, particularly in Florida, which it's gotten significantly better. Our Florida insurance went from about $500 a door in 2013 to $2,000 a door. We did our renewal in June. It's down to $1,000 or below a door. So, but then there's property, and then there's GL and umbrella. So sometimes it might make sense. I'll go on my own property program, but use my management company's GL and umbrella program. You can kind of mix and match.
Mix and match until you get your lowest sort of expense load, and that is okay with the lender and okay with you guys from an insurance perspective.
But what I learned, when I had joined is and again, it was very different at Avalon. We just had this insurance department, this insurance program, benefits of a REIT. It's like, well, gee, what's one of my biggest expenses? Insurance. Like, I should probably become an expert on how insurance is, because that's going to drive
the second largest expense.
Right. And then sure enough, it became even more and more. And so we try to get very creative. We've gone out to market to do an MIP again, and we will bid that against our regional programs. And every year we evaluate.
I mean, to a certain extent, I remember you were like moving flood zone kind of designations to the extent that you could, as it relates to having consultants look at.
Yeah. We did that. We've done that on some properties where a property might appear to be in a flood zone, but it's actually not. And there's a process to figure that out.
Right.
And we've saved 6 figures of insurance where you didn't need to buy excess flood, and you would actually have the coverage on your main policy if you did certain things to get it to get it out.
It's like a wizard.
But you do that. We do that like, well, we're underwriting the deal. We look to do that.